Welcome everyone, and thank you all for joining today's webinar. We're going to go ahead and get started. I'm Renika Lightborn, and I'm really excited to have our special guest, Mr. Bryan Ellis. Bryan is well known in the industry in terms of self-directing. He's also a senior real estate investor, and also is very popular for teaching investors on how to raise capital. Today, he's going to talk about what elite investors are doing to profit with economic uncertainties as we go through and we deal with COVID-19. So again, my name is Renika Lightborn. I'm the business development specialist here at Advanta. I've been with Advanta as an employee for almost a year now, but I'm also a client of Advanta. I personally and actively self-direct my IRA prior to joining. If you have questions or you would like to schedule a consultation, definitely feel free to give me a call or visit our website at advantaira.com. So before I hand it over to Bryan, I do want to kind of go through and give you a high-level view of what self-directing is and some of the options available to you. But a quick disclaimer before we get started. At Advanta, we don't give any tax, legal, or investment advice. We also don't endorse any particular products. All of the information that we provide to you is just more so for educational purposes. So as always, you're encouraged to do your own due diligence and definitely consult with your professional team before making any investments. Just a little bit about Advanta and who we are. We've been in the business for about nearly 20 years as one of the nation's leading self-directed IRA administrators. We do work with individual investors and investment providers nationwide to be able to use qualified retirement funds to invest in alternative assets. We do have well over $1 billion in assets under our administration. And Advanta, we're really known in the industry for providing our clients that high quality concierge service. For you, that means you have a dedicated account manager, a direct point of contact. Also, too, our other commitment as an administrator is to provide you an educational platform that's second to none, which includes hosting webinars and having guest speakers like Mr. Bryan Ellis to be able to, kind of elaborate in terms of what's going on in the industry. If you've never heard about self-directing or, it's something that's relatively new to you, that's okay. It's, self-directing has been around for a long time, but it's definitely now growing in popularity. The most common IRAs that we know are held by the banks and, brokerage firms. Their business model is stock, bonds, mutual funds. But at Advanta, our role is to kind of educate the public and let them know that, hey, you do have other options. So the IRS said that you can use IRA funds to really invest in a universal list of options and not just the traditional stock, bonds, mutual funds. So exactly what is a self-directed IRA? A self-directed IRA just simply means that you have the control to invest in what you know and understand. You have control over your retirement funds. You have the control over the investment decisions. So really you get to use your skill set or your interests to be able to grow and protect your retirement wealth. A lot of our clients here at Advanta do use IRA funds to invest in the likes of real estate, but you can also use those funds to invest in notes and mortgages, private equities, precious metals, heavy equipment, oil and gas rights. Really, the list goes on in terms of the options available to you. So why do people choose to self-direct? You may choose to self-direct for any number or combination of reasons. One, it can be a new source of capital for you. If you have money sitting in an old 401k, maybe you left a job a couple of years ago, you can absolutely roll those funds over to be able to use it for your next project. Another reason why you may choose to self-direct is because of the ups and downs in the stock market. We really have no control over that. A lot of investors look to self-direct, and because it gives you the ability to better control or diversify your account. A third reason as to why you may choose to self-direct is because of the tax benefits. The benefits of having those rents or profits flow back into your IRA tax-free or tax-deferred, depending on the type of account that you have. Also, too, if you're in a higher tax bracket or you don't want to deal with capital gains personally, you can elect to make that investment in your IRA and not have to worry about those taxes. Speaking of which, in terms of the types of accounts that can be self-directed, really any type of IRA, whether you have a traditional IRA or a Roth IRA, if you're self-employed, you can look to self-direct a SEP, simple, or solo 401k. The solo 401k does offer great flexibility. So if you do want to know more about that, definitely feel free to give me a call and we can schedule a consultation and talk more about that. Certainly any former employer plan, whether it's a 401k, 403b, or TSP type plan, you can self-direct. And then some of the lesser known accounts or the educational savings accounts and the health savings accounts that can be self-directed. The main thing that you do want to remember here is the annual contribution between the different accounts varies. And then of course with the Roth, the distribution is tax-free at retirement. In terms of getting started with us, at Advanta, we've really streamlined that process for you in 3 simple steps. Step 1 is just actually going through and opening up your account, filling out the appropriate application, and that can be done electronically. You can do it online. We'll be able to walk you through that process, answer any questions that you may have. And then step 2 is actually funding the account. Whether you're going to make a cash contribution that aligns with the annual contribution limits that the IRS has in place, or you're going to move funds over from that former employer plan, or you have the ability to, if you have an existing IRA, you can transfer those funds. It's trustee to trustee. There's no personal tax liabilities for you. You can move those funds over to make your investment. And then in step 3 is actually start investing. What type of alternative assets you have an interest in. The beauty is you get to decide what works best for you. Is it real estate? Is it notes and mortgages? Is it private equities? Is it precious metals or cryptocurrency? You pretty much get to decide when it comes to self-directing. If anyone has any questions, I know that was just more so a quick high-level overview of what self-directing is. If you have any questions throughout the presentation, definitely feel free to enter those in the question box, and we'll do our very best to get those answered for you. Again, if you have questions or you want to, schedule a consultation or talk through your exact scenario, definitely give me a call at 800-425-0653, extension 1133, or visit our website at advantaira.com. Again, that's an overview. I'm going to turn it over to our guest speaker, Mr. Bryan Ellis, and let him take it from there.
Excellent, thank you. So, just a confirmation, Renika, can you guys see my screen and see me talking?
Yes, I can.
Okay, cool. Ladies and gentlemen, we're going to do this a little bit differently today. I'm going to share some stuff with you on the screen, but mostly I'm just going to talk to you. And I would like to welcome, by the way, the folks on my Facebook page where we are streaming this live concurrently. I'm doing this presentation for Advanta IRA, ladies and gentlemen, who are in my group of Facebook friends, and I know I have a pretty wide reach into the self-directed IRA world, and I've referred more people to Advanta IRA than to any other IRA company, and there's a reason for that. So I certainly encourage you guys who are my friends and associates to go and check out Advanta and to reach out to Renika Lighthouse for assistance with that, because they'll do a great job for you. So with that, good afternoon, everybody. I'm Bryan Ellis. For reasons that you will come to understand, there's a long list of very, very savvy individual investors who all ask me for the same thing. These investors, all of whom are capable of and are accustomed to investing $100,000 or more at minimum in each project in which they participate, well, they invariably want me to do the same thing, which is to share with them first looks or inside scoops on exceptional elite investment opportunities, because they know I've got access to deal flow and opportunities that most savvy investors would kill to have. You'll understand why that's true momentarily. Now hold that in mind for a moment as we consider this fellow that we've all heard of, Warren Buffett. Warren Buffett. He's held out as the gold standard of investment opportunity in our society. If Warren Buffett says it, it's good as gold, right? No, turns out no. Warren Buffett routinely gives really bad, or at least dangerously incomplete investment advice. And you need not take my word for it. I'll prove that to you here momentarily. Now, as we go through, ladies and gentlemen, I hope that we have enough time together to dig in deep as much as possible together. If it turns out there's more that we need to talk about at the end, you can get on our list and make sure that we're able to communicate with you by texting Inner Circle to 555-888. You can do that anytime. Today, we're going to focus on a particular piece of advice that Buffett gave some time ago that's getting a lot of attention today in the wake of COVID-19 and protests and riots and all of the deep social uncertainty. And that famous advice that sounds so good is this: it's be fearful when others are greedy and greedy when others are fearful. Probably heard that one, haven't you? It's classic Buffett speak. But my friends, today we will not be venerating old St. Warren. Rather, I'll show you why that advice is likely to lead you down a very, very bad road. And I'll show you how to stop the problem in its tracks and actually capitalize on some truly extraordinary opportunities that are only now beginning to present themselves to savvy investors like you and me. So I'm not one to spend time on sharing my background because, let's face it, you don't really care, do you? That's okay. Yeah, if you want to check out the stuff I've written for Forbes or Entrepreneur or The Street or any of the other top tier publications, or if you want to check out the legal class that I teach for the University of California about self-directed IRA law, all that'd be fine. But if you'll allow me very quickly, a maximum of about 60 seconds to do something that I don't generally like to do at this point, I'm going to talk about myself, but there's a reason I'm talking about myself. I promise that you will find this deeply relevant to you and to your ability to choose great investments in the strange new world in which we all find ourselves at this time. I have a really special job. Among other things, what I do is I write webinar presentations, deeply persuasive webinar presentations. I do this for clients who are raising capital for big syndication projects in the private market. Like the little ones are $1 million all the way up to $100 million or so. These are elite, invitation-only types of projects that, well, they're generally inaccessible to the public. And in these projects, investors pool their capital and they take down big, exciting opportunities that they can never do on their own. They're called syndications. And it's mostly real estate projects that I work on. There are some exceptions, but it's mostly real estate projects that I work on. And where it comes to the notion of writing deeply persuasive webinars to help people raise capital, I'm the very best in the world at what I do. Nobody else is even close. I charge and I get, and I'm telling you all this for a reason. I'm not bragging to you, but I charge and I get $25,000 a day for consulting work. Now, that's not something that I've done once or twice ever. And I keep looking back to the high point and I keep bragging about it. It's not like that at all. I did one of those consultations yesterday, like June 15th, 2020, like yesterday. My next one is Friday of this week. I have an appointment 90 minutes from now to talk with someone who will likely hire me to do yet another one. I do this a lot. And all of my clients come by referral and not because I solicit them. And that's because my webinars are the technology version of the Midas touch for people who raise capital for big private investment projects. Now stick with me because this matters to you. And we're getting to why. You see, I see a lot of investment projects, a lot of them. Furthermore, I see them to a level of detail that nearly nobody else does or ever could, because when I do my consulting work, the very first thing I do with each project is that I spend 2 to 5 hours grilling the management team about every tiny detail of their projects. The good side, the bad side, the ugly, all of it. Then I use that information coupled with my rather deep experiential knowledge about psychology, persuasion, and human decision making, and I use that information to create webinars that are they quite consistently raise more money more quickly than any of my first-time clients would have ever believed possible. Now, here's why this matters to you, because it does. And by the way, this is where old St. Warren's insufficient advice rears its ugly head again. My friends, with COVID-19 and protests and riots and deep civil unrest having become the norm in America, if ever there's been a time where fear was a predominant emotion, it's now. And fear is, according to old Saint Buffett, the sign to let your greed glands swell. Remember his famous statement from years ago: be fearful when others are greedy, and be greedy when others are fearful. That's his classic advice. My friends, don't do that. Don't do it. I want to tell you what I see in the real world of investment projects. Information that you can't see unless you do what I do. You'll rather promptly see how to separate the wheat from the chaff. Now, at the end of April, the Wall Street Journal published an article that was all about how investors are pouring massive record amounts of money into distressed real estate funds. In fact, $297 billion was the number for April alone. Now let's think back to April. April was when coronavirus terror was at its absolute height. It was never worse than then. That's when everything had just shut down. People were literally staying inside their houses all the time because they were terrified of what was going on. Nobody knew what was happening. Nobody knew what was going to happen. It was a terrible, awful, fearful time. And yet, $297 billion of capital was poured into distressed real estate funds. This is where we saw something strange happen. There was one company called Kayne Anderson down in Florida. I don't know anything about them. I'm not saying anything good or bad about them. This was just covered in the article in the Wall Street Journal. These guys did a capital raise of $1.3 billion. Now, in normal times, that would have taken them 12 to 18 months. It took them 3 weeks. 3 weeks. Did you hear that? 3 weeks. If ever there's been irrational exuberance, this is it. Only this irrational exuberance is happening largely among people who you might otherwise think are really savvy investors. These are people, probably like many of you, who qualify to write a check for $100,000 plus to participate in private investment opportunities. So these are savvy people, and they're the ones throwing massive amounts of money at distressed real estate funds. I'm not pointing to this as an indicator of wisdom. I'm pointing to this as an indicator of, and I will turn my speaker down here in case there's some feedback coming in. I'm pointing to that as an indicator of irrational exuberance. I'm pointing to that as an indicator of people who are not thinking, not taking care, and not being careful in treating their capital with respect necessarily. Here's something else that I'm seeing. There's a lot of interest out there among syndicators. Again, these are the people who raise money from other people like you. There's a lot of interest among syndicators for this thing called a blind pool, or a blind fund. A blind fund is an investment fund in which investors like you place their capital into a pool with other investors, and their money will be used largely at the discretion of the syndicator. In other words, as if you're turning your money over to a third party and saying, do your best. And you're just hoping that they don't end up doing their worst instead. Now, contrast blind funds with the more common type of syndication, which is called an asset-specific syndication. In this scenario, investors partner up to take down one or multiple very specific assets in one project. Now, I'm not suggesting that either one of these types of funds are good or bad, but what I do know is this: blind funds are much riskier for investors, particularly those who have no prior experience with the syndicator running the project, than their asset-specific fund cousins. And blind funds become far more popular when another factor radically increases, and that factor is risk. And that, my friends, when there's fear in the market, even though old St. Warren tells us that means that you should become greedy, I'm here to tell you that those times when fear is on the rise, as is the case today, those times bring not just more opportunity, but more risk as well. And old St. Warren never bothered to point that out. So very quickly, what I'd like to do is tell you a bit about how to discern between projects that are fundamentally wise versus those that may be either unwise or inconclusive. Because at the end of the day, I know you want to show respect to your own capital. Your capital base is the economic sum total of your blood, sweat, and tears. Your capital base is the economic sum total of all the times that you worked way past 5 o'clock, and all the times that you had to miss the T-ball game, all the times that you didn't take the vacation or enjoy the long weekend like you should have. You've got to show respect for your capital, because that's the scorecard for part of what you've done. So with that in mind, let's take a look at a quick case study that does exactly that. This case study gives a huge opportunity for profit while absolutely showing respect for your capital. Now, I'd like to point out that the project I'm about to describe to you is a real project. Like, this is a project where we're presently raising money for. We're presently making this available to qualified investors. However, I'm not pitching this to you today. This is not an investment page. This project is not known to or approved by Advanta. All right. At no time today will I give you instructions for getting involved in this project, because that's not why we're here. But what this project is a great example of what to look for if you truly want to show respect to your own capital while simultaneously absolutely capitalizing on the opportunities created by COVID-19 and all the rest. So for a very quick overview of this project we're using as a case study, let's do that now. Internally, we call this project the 2020 RV Fund. It's a fund where we're acquiring 2 specific RV parks, recreational vehicle parks, for value additions and later resale. Now, no doubt you know what an RV is. It's one of those, it's like a private hotel room on wheels that they enable their owners to travel the country and have a private room, private accommodations, and they never have to take the health risk of flying on a plane or staying in a hotel room or anything like that. Now, we are raising about $7.5 million for this project. And when I choose, in my business, when I choose whether to take on a client for a capital raise, which, by the way, also involves my risking my reputation, because I have to recommend those projects to my individual investor clients. Well, I look very, very closely at each project. And again, you've got to understand that because of the sheer amount of deal flow that I have. Remember, I'm doing a deep dive on 2 different projects this week alone. So I get to see in great detail, far more detail than most, and I'm blessed. And with all thanks and glory to God for this particular blessing, for sure. But I am blessed to have the ability to turn down any project I don't absolutely love. And I do turn down nearly all of the projects that I'm offered to work on for raising capital. But that's not true for the one I'm about to share with you. And it makes for a great model for you if you are looking for opportunity or looking for a way to have a clear standard for evaluating other opportunities in the future. So this one makes the cut in a huge way for reasons I'm about to share with you. We call it, again, the 2020 RV Fund, and there are 7 specific reasons that this project and any other project that meets these criteria really makes the grade, even today, even during times of astounding stress, astounding fear, and a totally different world out there. This one makes the cut, and any that have these particular characteristics do as well. First, this project, this RV project, what we're going to do from an overview point of view, what we're going to do is we are acquiring these 2 parks, and we've done it already, actually. We're acquiring 2 RV parks. We're doing some improvement to them to increase their cash flow, and then we're going to sell them off using a specific strategy in a few years. And we're expecting a massive, massive, massive profit as a result. Now, I'm not going to get into the details because, like I said, I'm not pitching this project. But this project, right now, today, before any investor actually invests any money whatsoever, right now, today, this project that we are offering to our investor base, right now, today, this thing is profitable by over $1 million a year, like net profit, not gross, net profit, by over $1 million a year. So that's the starting line for this project. We are not taking a project where it's bleeding money and there's a massive turnaround that has to happen. I'm not saying that those can't work. I'm saying that in days like we have now, times like we have now, you've got to respect your capital. And if you can start ahead of the game, that's a great, great thing to do. That's what we're doing in this one. It's currently profitable. So that's number 1. Number 2, this project, the 2020 RV Fund, is in a strong asset class to begin with. Now, I'm sure you know what I mean by asset class, but just in case, like shares of Microsoft or Google or whatever. Those are shares of a particular company. The asset class is stock, publicly traded stock, right? So for these parks, these RV parks, the asset class is RV parks and campgrounds. That's the general class in which they are located. Now, in this case, the asset class itself is very, very strong. You probably don't know this unless you pay attention to lots of alternative asset classes, but RV parks have been performing very, very, very impressively and steadily on an uptrend for many, many years now, including, by the way, in every instance of economic downturn that we've seen, including the Great Recession and including COVID-19. Every time we've seen economic downturn, RV parks actually improve in profitability and grow in exposure for reasons that make sense. It's cheaper to go to RV parks. It's cheaper to do that sort of thing. But the big idea here, ladies and gentlemen, is that the asset class itself is very, very strong. You probably know the phrase, a rising tide lifts all boats. Well, if you want to really respect your capital and take as little risk as possible, what you're going to do is focus not just on specifically profitable assets, but specifically profitable assets in asset classes that are themselves a rising tide. That is absolutely the case for the for the 2020 RV fund, and for anything that you should look for if you want to make sure that your capital base is not just capable of growing, but also very well protected. The third reason, the first two were currently profitable and a strong asset class. The third reason is that there is, on the part of the managers of this project, there is a very, very, very clear plan for improving the profitability of this project. And as you probably know, that's the whole idea. The more profitable the project is, the more we can sell it for in the future. And it's really amazing. Like the more closely a project can tie specific activities to increases in value for your project, the more predictable it is. For example, in this case, one of the things that we know is that by adding more cabins to our RV parks, that's almost a gimme for improved revenue and improved profitability, because we can put these cabins in, and generally within about 2 years, the cash flow from a normal 2 seasons worth of income will have paid for the cabins entirely. And what we also know, because of the way that these parks are valued, that for every 4 cabins that you add to these properties, the value of the property itself goes up by about $1 million. Well, we're going to be adding, to start with, about 17 of them. So this project is going to go up by a little over $4 million based on that. And then each year the rents are going to go up as well. So it's going to go up based on that. Here's the point. There is a clear plan in this project for improving profitability. And that's not the whole story, but you need to be able to explain to yourself and to other people who may be less financially savvy than you, here's the reason why this project is worth investing. The reason that they're going to be able to improve profitability is this and this and this. And it has to make sense to a 12-year-old, maybe to an 8-year-old. If it doesn't make sense, then there's probably some risk there that you just have to be aware of. All right. So those are the first 3 things. The fourth is that there has to be a clear and very plausible exit plan. Now, for this project, the exit plan is simply that we're going to take these 2 projects that we already have, they're already net profitable. We're going to increase the value of them fairly substantially, actually. And then we're going to start buying in other RV parks, all right, other RV parks. And we're going to sell them in 3 to 5 years, maybe less because of what we're seeing already. This one's just working out beautifully before we even started the capital raise, really. But what's going to happen is that in 3 to 5 years, we're going to sell those assets off as a group to some of the bigger money interests on Wall Street. Now, Wall Street doesn't really play a whole lot in the RV park space right now, other than Sam Zell. You may have heard the name Sam Zell. He's worth a little over $5 billion. And he is the CEO of at least 2 different publicly traded REITs. He's the single largest owner of RV parks in the country. But there are others getting in. The reason why RV parks have not been as heavily targeted by Wall Street yet is because of a reason called fracturing. There's a lot of fracturing in that industry. In other words, every park, with the exception of what Zell owns, every park, which is the vast majority of them, is owned by a separate individual owner, by and large. And it is not worth the time for people on Wall Street dealing with hundreds of millions of dollars to go and bother to buy a small park here and a small park there and a small park there. What they need is a bigger asset, a roll-up is what it's called, of multiple high-quality assets so that they can make one larger investment and avoid the problems that come with fracturing. We're going to solve that problem. We are going to solve that problem. And our exit plan is to unload these products in 3 to 5 years from now, probably on the shorter end of that, because I'm grateful to say that we have not been wrong about our predictions about the demand for these kind of assets among savvy investors. So the 4th thing is a strong exit plan. The 5th thing is you need to look for managers, people who are running the projects that are highly, highly invested. And I don't mean in their time, I mean in their money. In this project, for example, the managers of the project were so confident of this project that they actually went ahead back in December when they found these 2 RV parks. They're both beautiful properties, by the way. I'm not pitching it to you today, but these guys are very, very bright, very, very savvy at choosing assets. But they were so convinced of the viability of this plan that back in December, they found these projects then. They went ahead and bought both of them with their own money and their own credit. Like, they've already bought these properties. They didn't want to wait to raise capital because they knew that these specific projects were deeply desirable, deeply attractive. So they are heavily invested. That's a great example. That's something that you want to look for is the management team, the people who are in control of the levers of power in this project. Do they have their money in the deal? Is their money where their mouth is on the project? If it is, and particularly if they put their money where their mouth is in a big way, man, that's a great sign for you. That's a great sign for you. All right, so those are the first 5. Currently profitable, strong asset class, a clear plan for improving profitability, a clear exit plan, and managers that are highly, highly invested. We've only got 2 more. Number 6 is strong ROI potential. Yeah, everything I've been sharing with you, my friends, has been aligned towards the notion of reducing your risk, but that does not mean, by the way, that there's not huge opportunity or huge return potential to be had. This project, the managers are projecting what's called an internal rate of return of 27% per year over 3 to 5 years. 27% per year. Now, Warren Buffett, who we mentioned earlier, do you have any idea what he's been averaging for the last 20 years? You're probably thinking 15, 20, maybe 25%, right? Maybe 30%. Nope, 8%. 8. Don't trust me, look it up. This company is called Berkshire Hathaway. Just look where they were on January 1, 2020. Look where they are today. You'll see that number is about 8% compounded per year. That's not great. This project, we very realistically expect it to be something on the order of 27%. All right, that's attractive. Like, those are numbers that can have a big impact on your portfolio in a short period of time, right? So that's very, very attractive. But this brings us to the question of, can you trust the numbers that syndicators put in front of you whenever you're considering an investment in their projects? And the answer is, you should not necessarily assume that you can trust anything from anybody. But this goes to point number 7, the last thing that you need to look for, and that is deep experience from managers. This is one that you ought to consider to be an absolute requirement in a day and age like we have right now. Right now, there's a lot of people out there who have been doing syndications for the last 3 to 10 years. Okay, and that's all well and good, but that's not really a full economic cycle. That's not really somebody who understands what it's like to go like this in the economy over a long period of time. What you want is somebody who's seen that, who's been there, who's done it repeatedly, and who knows how to deal with it, and there is utmost evidence for it. Well, in this project, let me give you an example of what I'm talking about. There are 2 primary managers on this project. The lesser experienced of the 2 is a guy that has over $500 million worth of project management experience in real estate projects, like successful project management real estate experience. The guy has an intuition about real estate deals I haven't seen anything like this anywhere ever. And he's got over $500 million worth of that kind of experience. But he's the junior guy on this deal. The senior guy on this deal has over $5 billion worth of successful real estate project experience. His name is Chris Kalavokis. I mean, you can look him up if you want to. He is an absolutely known quantity on Wall Street. His firm is called RER Financial. And whenever his client list is Goldman Sachs, BlackRock, Carlyle, Fortress, the biggest of the big. His firm is an analytics and due diligence firm, right? And he is absolutely cream of the crop in that business. And that, by the way, his analytics background and his due diligence background, that's why in this case, they and I have so much confidence that their projections about what this will turn out like for investors. That's why we have so much confidence in it, because that's what this guy does. And by the way, he's 76 years old. He's been doing this for 50 years, 5 decades. And he's never been sued. He's never gone bankrupt. The guy has a reputation of gold. Guys, that's what you want to look for. Like those 7 things. Is the project in its current state right now, the project you're considering investing in, particularly if you're looking at a syndication, but really anything, is the project currently profitable? Is it in a strong asset class? Is there a clear plan for improving the profitability of the project as it exists? Is there a clear exit plan? Ideally one that relies not just on performance of that asset, but also positioning in the marketplace. Number 5, are the managers themselves heavily invested, right? And number 6, is there strong ROI potential? You don't need to sacrifice great results just because you're being prudent about choosing your investment opportunities. And 7th, are the managers in the project deeply experienced? Now, if you are able to identify a project that meets those criteria, my friends, I'm not telling you that it will be a winner. I'm not telling you that you won't lose money, but I'm telling you that the odds are going to be crazy in your favor. Crazy in your favor. This is the kind of stuff that really savvy investors who have been there and done that, these are the kind of factors that they look for. And if you adopt a similar criteria, what you're going to find, my friends, is that you take fewer investment opportunities than your friends do. Like you jump into fewer of them. But you're going to find that you have a much higher percentage of success, because these are all about fundamentals. These are all about fundamentals. And you see, Warren Buffett told us, as we all know, be fearful when others are greedy and greedy when others are fearful. But my friends, here is the harsh reality. If the economy is an ocean and you're out in a boat, you're going to drown and die if there is a hole in your boat and it sinks. And it doesn't matter whether you were feeling fearful or whether you were feeling greedy. You're going to drown and die because there's a hole in your boat. that's a fundamental issue. These are the fundamentals that you need to be concerned with, because the result will be the same for your portfolio if you don't take equal care for the fundamentals that you should be evaluating for investment opportunities. Now, what I'm going to do is I want to reiterate something real quickly, and that is that I have shared with you some details of a particular project. Again, I am not pitching that project to you. I'm sharing it with you as a case study, as a model, so that you can use the criteria of that project to evaluate anything that you might be considering deploying your capital into. Okay. And so I'm going to take questions or go into a bit of discussion here in just a moment. There's more I can share with you guys, but I want to make sure that that I hit what you guys really need to hear. But before I do that, what I want to do is reiterate to you that if you'd like to stay in touch, if you'd like to hear more about other things that we're doing or other opportunities as they arise, and some of the guys, like I told you, I will say one more thing here real quickly. Because of the fact that I see so many projects, here's the way that it works in my business. People come to me and they ask me to write a webinar for them so that they can raise capital. Invariably, or very frequently, what happens is that a company who has deep experience in raising capital, they've done it lots, they've probably been pretty successful at it, but maybe they get to a point where they're 10 days before they have to have $5 million more than they have right now, and they're out of options. So they call me. I'm kind of the guy that puts out fires. That's what my webinars do. They kind of make magic in terms of raising capital. So people call me for that reason, and I have to dig into their project very, very deeply to understand what they're doing. Well, the vast majority of the time after I do that, the person on the other end who is running this project, they will say, Bryan, that's a great webinar. I know it's going to work. Will you just do the whole process for us? Will you run the webinar? Will you evaluate the investors? Will you collect the money? Will you run the capital raise? And the vast majority of the time I say no. It's not because the deals, most of the deals aren't pretty good deals, because basically all of them, with a few exceptions, but basically all of them are pretty good deals. Like, people don't spend as much as I charge for creating a webinar to raise capital for a project. People don't spend that much unless they are pretty confident that they have a good deal. So they do that. They then ask me if I will raise the capital for them. Almost always I say no, not because the deals aren't good, but because again, thank you, God, I don't have to say yes to any of them. So I choose to say yes only to the really great ones. And because of that, we get some amazing things. Now, we don't have amazing things all the time because I only present the great ones, but we have, Renika mentioned earlier that Advanta can accommodate oil and gas interests. Guys, we have oil and gas deals fairly frequently, actually, that if your frame of reference is investing in single family houses or multifamily property or really any real estate kind of deal, the numbers in that business, the numbers in good oil and gas deals will blow your mind. Like, it really is like that. Now, it is higher risk. That's not something that everybody should do. Like, those projects don't necessarily meet every criteria that I demand for a conservative, all-round type of transaction, but it offers other benefits as well. So if you're interested in that sort of thing, and you want are interested in us reaching out to you whenever there are those opportunities and telling you a little about them, you can text Inner Circle, no spaces, just text the word Inner Circle to 555-888, and we'll be happy to stay in touch with you. Now, Renika, I'm going to invite you to come back on. Can you hear me right now?
Yes, I sure can. I do have a couple questions.
Please.
If you're open to questions.
Sure.
So one of the questions is, okay, so what's the how can the average self-directed investor go about identifying those type of investments that you just touched on in terms of making sure you apply the 7 steps?
So how can the average real estate or self-directed investor find these opportunities?
Yeah, identify. Mm-hmm.
Yeah. So Renika and everybody on the line, I wish I could tell you something different than this, but it is still the best way is to be connected with people who are kind of in the flow of opportunity. There are sites that you can go to that are crowdfunding type things where their projects are publicly listed and you can buy into a small piece of them. And so that's an option. That's not something that I've ever done any of, so I don't have anything good or bad to say about it. But for my clients, the way that it happens for them is that we encounter them however we encounter them, maybe on a webinar, maybe in person, maybe I speak at a lot of conferences, and so those people get on my inner circle list, and so we follow up with them and make sure that they know about the projects that I'm seeing at least, which tends to be a pretty good flow of them. But the real solution to that is be out there, pay attention, be asking around, and really when you find other people who are successful at investing in syndications and other kinds of transactions like that, befriend them. Make sure that you find out what they're doing, how they found what they found, and what their results have been. This is a social thing. And the biggest safety net for you is to find deals by way of great referrals and people that you trust more than anything else.
Okay, great. I have another question. So I know you touched on real estate and also briefly about oil and gas. What other asset class do you see, successful investors investing in right now, given the current climate?
Yeah. So on the self-directed side of the world, it is largely real estate. Oil and gas is a tiny, tiny percentage. Most people do oil and gas investments outside of their IRAs, although they can be done inside your IRA, and there's some good reasons to do that. But outside of those asset classes, for a while there was a lot of interest in cryptocurrencies. That seems to have waned, and I think with good reason. There will be opportunities there in the future, but I'm not sure that we're there yet on a mass scale. Obviously, private equity, people buying into companies that are pre-IPO, that tends to be a pretty attractive area. Also, it's still kind of real estate related, but notes and debt instruments, those are areas and asset classes that tend to be of great interest to self-directed investors in particular. But in the broader world right now, there's a massive amount of interest in distressed real estate investment opportunities and also multifamily housing. Those are really the high points.
Okay, another question that I have that came in, you talked about having a clear exit plan, exit strategy. Do you, while doing your due diligence, do you have it built into where you see investors are prepping to possibly having to stay in the investment a lot longer, or, being able to extend the time frame given what's happening now? Like, do you see investors staying in?
So yeah, so if I understand the question correctly, it's do I see investors having to keep their money in these syndications longer than they planned? Is that about the size of it? Yeah, so not yet, because we're not there yet. That's probably going to happen in a number of the syndications that are already, there are thousands of these things that happen every year. Like they're not rare. And so what I expect is that it really hasn't started, like the bloodbath in syndications that existed before COVID-19. That bloodbath hasn't started yet. We don't really see that yet. We're just starting to feel the tremors of it right now. Like this very morning, like today, like 30 minutes before I got on this webinar, one of my partners, one of the guys that's one of the managers of the project that I just described, wrote to me and said, he said basically that he's found a portfolio worth legitimately $1 billion that he can get for 35 cents on the dollar. Well, that stuff really hasn't started to happen en masse yet, but it is going to happen. And if you are involved in a syndication where you fear that could be the case, might make sense to go ahead and go the other way if there's any way for you to withdraw your money. If there's not, then just watch and see what happens, because honestly, I think our economy is going to turn out okay, but there will be a number of syndications and investment partnerships that still go bust, that still get slaughtered, not because the project itself isn't good, but because the managers weren't smart enough to have a good amount of reserves on hand. And so what happened during COVID-19 and the stress of that is going to cause those guys to have some real problems. But it's too early to know if it's really going to translate into people having to stay in these deals longer than they really wanted to stay in.
Okay. Another question that just came in. Obviously, I know that you work with, a lot of bigger, investors looking to raise capital, but for the average everyday self-directed investor, if they're, looking to invest in, say, single family or, smaller multifamily, when's a good time for them to raise capital? I mean, obviously accounting for COVID-19. So when is the right time to raise capital?
Yeah, I mean,
what's the question?
Number one, raising capital generally isn't necessary if what you're doing is single family houses. That's the domain of individual loans. Unless you're doing lots and lots and lots of them. But right now is actually a great time to be raising capital. As I mentioned to you, that article in the Wall Street Journal showed that in April alone, there was $297 billion being thrown at distressed real estate funds. That is not normal. That's a lot of money. And something that is unique about our situation right now, Renika, is that it's pretty obvious that the recession that we find ourselves in right now is not an economic recession. It was created as a result. It's an artificial recession that was created as a result of political machinations. And so as things start to unwind and the rest of the country starts to get back to work, every indication right now is that the economy is going to boom upwards quite hard, quite rapidly. Now, even if I'm wrong about that, I still think that we're going to have a pretty good recovery. But the point here is this: if you're thinking about raising capital for multifamily or for whatever, now's a great time to do it, because I think that the economy is going to be agreeing with just about everything. So the economy is probably going to boom up nicely. And this is just like a blip, and it's a short blip in time. If you have something that makes sense, get out there after it. That's what we're doing, guys. I mean, now's the time to, as that guy on some Hulu show says, get her done. Now's the time.
Okay, I have one or two more questions. So in terms of, I know you referenced for the project, that the case study that you did, you talked about, having deep experience. So the question came in, okay, how do you go about, doing the legwork to make sure you do the due diligence on the management team? What if they don't have that experience that you reference?
Then you don't get in the deal. There are times when, I mentioned a little while ago this concept of a rising tide lifts all boats. And there are times when the economy itself is so strong that it doesn't really particularly take any great skill as a manager to make a project end up being profitable. We've been in one of those times for the last 3 years up until mid-March of this year. And I suspect we'll be in one again. But here's the thing: whenever you are investing in a syndication, the syndication, part of the documentation that they provide to you should be a pretty thorough resume and background of each of the people involved in the project. And number one, if there isn't that, then you should run away, because that means they don't want you to know about the experience of the project manager or the syndicator. But if there is that, or even if there's not, the question is, do you want to trust lots of money to these people? Because for most syndications, it's $50,000 on the real low end as the minimum buy-in. On all the projects that I work on, 100 grand is the absolute minimum buy-in, and for some of them, it's much larger than that. So the question is, do you want to entrust that much money to somebody unless you can do real due diligence on them? The internet's made that a lot easier. So if you've got to decide what standards of experience are good for you. But I'm telling you that for me, it makes sense if you want to be conservative and careful in times like we're in right now. Make sure that you work with a team where at least one of the managers has deep, long, multi-decade experience, like they've seen multiple bloody recessions. Because otherwise, how can you have any hope that they can steer you through the one that we're looking at right now?
Okay, another question that came in, have you seen any deals in distressed funds for retail strip malls or malls investments due to COVID? So
I
have you
haven't.
seen?
Yeah, I haven't worked on any of those yet. I do know that one of the clients that I'm going to be working with in the very near future is that. I don't know if she is representing a fund or a particular asset, but that stuff is coming. Yeah, that stuff is coming. So there will be those opportunities.
Okay, we're getting close to the top of the hour. Do you have any other golden nuggets you want to throw out before I end today's webinar?
Yeah. No, I just say that if you, ladies and gentlemen, if you have not yet considered the idea of investing via syndications and via investment partnerships, you really ought to think about that. You ought to think about it because that's a way for you to get access to really top tier investment talent and access to investment opportunities that otherwise you just could not get access to. And I don't want to speak for Renika, but I'm willing to bet pretty big that Advanta is able to accommodate investments in syndications and investment partnerships because they are a very flexible and capable IRA company. So if whether you want to do that with your outside of retirement money or your inside of retirement money, it's probably going to be an option for you. So think about that if you've never done it before and look into it because it can be a huge opportunity.
Okay, great. Let me, and yes, we do work with a lot of individual investors as well as investment providers, investing in those types of alternative assets.
Sure.
Let me, Bryan, I really appreciate you taking the time to kind of give us, just an overview of the 7 steps in terms of what you're seeing, having the inside track on what investors should look for when considering syndication deals or just any type of investments. Thank you all for joining today's webinar. If you have questions or you want to talk through your scenario, you want to discuss anything relating to self-direction, feel free to give me a call. Again, I'll be more than happy to talk you through the process. Here's Bryan's information. Again, you can reach out to him at Bryan@bryanellis.com. Bryan, feel free to provide your number or that text.
Yeah. Just the best thing, ladies and gentlemen, is just get out your cell phone and text Inner Circle to 555-888, and that's the best way to get my contact info.
Okay, perfect. Thank you so much for, again, being our speaker today. Thank you, everyone, for attending today's webinar, and stay well.
Thank you.